Over the last several trading sessions, three things happened that most people are still treating like separate stories. BlackRock's IBIT took in another $109.3 million on March 9th and $185.8 million on March 10th. Strategy bought 17,994 Bitcoin in the week, ended March 8th, and Glassnode still shows less than 3 million Bitcoin sitting on exchange addresses. By the end of this video, you'll see why those three facts point to the same conclusion. The Bitcoin market may look weak and noisy on the surface, but underneath it, liquid supply is getting tighter while Wall Street keeps building bigger pipes to absorb coins. And that matters because the headline narrative right now sounds deceptively simple. Bitcoin is trading around $750 today, far below the October 2025 high, above $125,000. So the lazy conclusion is that the institutional wave is over, the easy trade is gone, and risk appetite has cooled. But markets do not move only on excitement. They move on inventory. They move on who is taking supply out of the floating pool, how much fresh supply is still being created, and whether the next buyer is a tourist or a balance sheet with deep pockets. That is the first thing the mainstream still refuses to connect. Price is one layer of the story, flow is another, and supply that is technically in existence is not the same thing as supply that is actually liquid, reachable, and willing to sell at today's price. In metals, people talk about paper versus physical. In Bitcoin, the equivalent tension is price discovery on screens versus coins that are actually available in size when institutions come looking for exposure. The media keeps talking about the chart. It spends far less time talking about the float. Start with the part nobody can negotiate with: new issuance. Since the April 2024 halving, the Bitcoin block reward has been 3.125 BTC per block, which works out to roughly 450 new Bitcoin per day. Coinbase and Glassnode's Q1 2026 report also lists Bitcoin's inflation rate at just 0.82%, with a circulating supply of about 19.97 million coins. Let me translate that. This is not an asset where higher demand triggers a wave of new production next quarter. The protocol does not care. Supply growth is slow, fixed, and already known in advance. Now put that fixed issuance next to what BlackRock is holding. As of March 10, 2026, BlackRock's own IBIT page showed $54.28 billion in net assets, 1.36744 billion shares outstanding, and a basket Bitcoin amount of 22.67. The trust's SEC filing says one creation basket is 40,000 shares. Do the math, and IBIT alone works out to roughly 775,000 Bitcoin. That is not a small position. That is about 1,722 days of post-halving new issuance. More than 4.5 years of fresh supply sitting in one Wall Street wrapper. Read that again, one ETF. More than 4.5 years of new coins at today's issuance rate. And this is not just a one-fund story. Farside's running total shows U.S. spot Bitcoin ETFs have seen about $55.77 billion of net inflows since launch. IBIT alone accounts for about $62.76 billion of cumulative inflows, while Grayscale's legacy vehicle has lost about $25.91 billion. That is a massive structural rotation. Capital leaving the older high-friction product and moving into cleaner, lower-fee, more scalable institutional wrappers. So when people say Wall Street already bought Bitcoin, that misses the point. Wall Street didn't just buy Bitcoin, it built a more efficient machine for continuing to buy Bitcoin. And here's where the recent tape gets really interesting. From March 2 through March 10th, the U.S. spot Bitcoin ETF complex took in $458.2 million, then $225.2 million, then $461.9 million, gave some back on March 5th and 6th, and then swung positive again with $167.1 million and $246.9 million on March 9 and 10. Net it all out, and those 7 trading sessions still represent about $982.5 million of inflows. At today's Bitcoin price, that is roughly 14,000 Bitcoin worth of demand. Now compare that with protocol supply. 7 days of post-halving issuance is only about 3,150 Bitcoin. So even after including the ugly red days, that week of ETF activity still represented demand equivalent to more than 4.4 times the number of new coins the network produced over the same period. This is why staring only at daily candles gives people a broken picture. The flow is not clean, and it is not one-directional every session, but the demand channel is still large enough to overpower new issuance when it switches back on. And that brings us to the next signal: accessible inventory. Glassnode's exchange balance chart currently shows 2.9918 million Bitcoin on exchange addresses. Against the roughly 19.97 million circulating supply listed in the Coinbase and Glassnode report, that is only about 15% of circulating coins. No, that does not mean every exchange coin is for sale. And no, it does not mean every off-exchange coin is permanently locked away, but it does mean the readily reachable pile is much smaller than the total supply headline most people carry around in their heads. For scale, take IBIT's roughly 775,000 Bitcoin and add Strategy's 738,731 Bitcoin. Together, that comes to just over 1.51 million coins. That is about 50.6% of the entire exchange balance. Glassnode is tracking right now. It is not a perfect apples-to-apples comparison because ETF custody and exchange balances are different categories, but it is an excellent scale comparison. Two large, highly visible institutional entities now account for an amount of Bitcoin equal to roughly half of what Glassnode sees on exchanges. That is what tightening float looks like in the real world. It does not arrive with fireworks. It arrives with custody statements. So now we hit the contradiction that confuses people. If supply is tightening, if Wall Street products are still pulling coins, and if public company treasuries are still adding, why isn't Bitcoin already exploding to a new all-time high? Why are we even having this conversation with price around $70,000 instead of $120,000? That question matters because if you cannot answer it honestly, you end up sounding like every other lazy bull on the internet. The answer is that tighter supply does not mean zero sellers. It means the market is entering a fight between shrinking float and very real overhead inventory. Glassnode's February report described Bitcoin as defensive inside the $60,000 to $72,000 zone, with large supply clusters between $82,000 and $97,000 and another between $100,000 and $117,000 acting as overhead resistance. Let me translate that. A huge cohort bought much higher. Many of them are trapped, so every rally is not just a bullish breakout attempt. It is also a chance for old buyers to get out. That is why price can look sluggish even when the underlying supply story is tightening. Glassnode also said spot volume has often been reactive rather than constructive. Treasury flows flipped into outflows during the sell-off, and futures positioning cooled as speculative momentum faded. In plain English, the market has been absorbing supply, but not yet with the kind of one-way, aggressive, no-doubt bid that turns a squeeze into a runaway move. This is not a euphoric market. It is a market working through inventory while institutions keep coming back through regulated channels. And that distinction is everything, because once you understand it, the recent behavior starts making sense. Price weakness does not automatically mean the structural demand thesis failed. It can also mean the market is still chewing through old overhead supply before the tightening float actually shows up in the tape. In other words, Bitcoin may be in a range not because the demand story disappeared, but because the market is still clearing the last cycle's baggage. That is a very different message from the one most headlines are pushing. Now here's the part that gets more interesting the deeper you go. Glassnode's January 14th report said institutional balance sheet flows had stabilized after a full de-risking cycle. Aggregate exchange flows had shifted into buy-dominant regimes. Coinbase sell pressure had materially eased, and long-term holder distribution was slowing. That matters because it tells you the sell-side intensity that dominated late 2025 was already beginning to fade before this latest March rebound in ETF flows showed up. In other words, the market was not facing the same level of internal dumping pressure it had a few months earlier. Glassnode later added that ETF selling pressure had cooled and buy-side interest was beginning to rebuild, even though short-term conditions remained fragile. That is a subtle but important signal. It tells you the market can still look messy, defensive, and range-bound, while the actual balance of flows quietly improves underneath. The mainstream prefers clear narratives. Either institutions are in or they are out. Real markets are rarely that clean. More often, they transition. And transitions are where the best signal hides. There is another clue hiding in derivatives. Coinbase. And Glassnode's Q1 2026 report said Bitcoin options open interest had overtaken perpetual futures open interest as participants sought protection after the late 2025 liquidation. They also noted the leverage ratio had fallen to just 3% of the total crypto market cap. That means this market has become more hedged and less frothy, less casino, more insurance. And that changes the character of the move. It often means less upside fireworks in the short run, but it also means fewer unstable paper longs that need to be washed out before a real spot-driven advance can happen. That is your mid-video pattern interrupt right there. A more mature, more hedged market can absorb large inflows without immediately going vertical. That looks boring if you only understand price. But if you understand structure, it is often exactly what happens before the visible breakout, not after it. The hot money leverage has to cool, the trapped supply has to get worked through, the float has to tighten quietly, then one day the same market that looked dead suddenly cannot find coins at the old price anymore. Now let's talk miners, because this is where the supply side becomes even more concrete. After the 2024 halving, miners have been dealing with a much smaller block subsidy. Coinbase and Glassnode said the Puel multiple fell to 0.9 in the fourth quarter of 2025, implying miners were earning about 10% less than the average of the prior year. So yes, miners still sell. They have bills, they have debt, they have capital expenditure. They are not sitting in a monastery protecting your scarcity thesis, but that does not cancel the supply squeeze. It proves why the new supply pipe is so constrained to begin with. Look at a real miner. CleanSpark's February 2026 update showed 568 Bitcoin produced in the month, 553.02 Bitcoin sold from monthly production, and 13,263 Bitcoin still held on the balance sheet at month end. That is a useful reality check. A big miner can still monetize production, and it can still hold a treasury at the same time. But the production numbers are tiny relative to ETF demand when the ETF channel wakes up. One strong day of US spot ETF inflows on March 2nd, about $458.2 million, equaled roughly 6,531 Bitcoin at current prices. That is more than 11 times CleanSpark's entire February production, one day versus 1 month. And that is before we get to corporate treasury demand, which is the second major non-miner demand rail people keep underestimating. Strategy did not buy 17,994 Bitcoin last week because it suddenly discovered the asset. It bought because its business model has effectively turned Wall Street capital markets into a Bitcoin acquisition engine. Barron's reported the company bought those coins for about $1.28 billion between March 2 and March 8, bringing total holdings to 738,731 Bitcoin, acquired at an average price of $75,862. Strategy's own purchases page confirms the 738,731 total. Put that in issuance terms and the scale becomes ridiculous. Strategy's current holdings represent about 1,642 days of new Bitcoin issuance at the present 450 BTC per day rate. Its single one-week purchase of 17,994 Bitcoin equals about 5.7 times 7 days of new network supply. So even if ETF flows go quiet for a stretch, the market still has another demand rail sitting there. Public company treasuries that can raise capital, tap equity, issue preferreds, and turn those funds into spot Bitcoin demand. That is not retail speculation. That is balance sheet plumbing, and the infrastructure is still expanding. On January 6, 2026, Morgan Stanley Investment Management announced that it had filed initial registration statements with the SEC for a Morgan Stanley Bitcoin Trust and a Morgan Stanley Solana Trust. The SEC filing page confirms the S1 filing date of January 6, 2026. Why does that matter? Because it shows a major legacy institution is not backing away from the category after the 2025 drawdown. It is moving deeper into it. Wall Street is not tearing down the Bitcoin product stack. It is still adding lanes. This is the point where the whole picture comes together. Fixed post-halving issuance, large ETF custody balances, public company treasury accumulation, exchange inventories below 3 million coins, long-term holder distribution slowing, Coinbase side sell pressure easing, and traditional finance continuing to file, package, and distribute regulated Bitcoin products. Any one of those signals on its own might not be decisive, but stacked together, they start telling the same story from different angles. The float is getting stickier, while access for institutions keeps getting easier. That does not mean the next move is guaranteed to be straight up. Glassnode's own work is clear that the market is still fragile. Short-term holder conditions have been weak, overhead supply is heavy, spot demand has not yet been overwhelmingly aggressive. If the $60,000 to $72,000 demand corridor fails, the market can absolutely see more pain. This is not a hype script, this is a structure script, and structure says the market is caught between shrinking liquid supply and still unresolved legacy supply from higher prices. But that is exactly why this matters for serious investors. When a market has unresolved overhead supply, the price can look disappointing for longer than people expect. When a market also has tightening float, the eventual move can be more violent than people expect. Those two conditions can exist at the same time. In fact, they often do right before the broader narrative changes. The market bores people first, then it reprices. That is how big structural turns usually feel in real time. So what is the cleanest way to frame this? Bitcoin is developing its own version of a paper versus physical tension. On one side, you have charts, derivatives, headlines, and traders reacting to macro shocks, rate cut expectations, and geopolitical noise. On the other side, you have coins steadily moving into ETFs, treasuries, and colder forms of custody, with only 450 new coins a day coming from the protocol. Those are not the same thing. The screen price can look indecisive long after the underlying inventory situation has started to tighten, and that is also why so many people get caught flat-footed. They think a supply squeeze has to look dramatic from day one. It usually doesn't. It often looks like frustration. It looks like repeated failures. It looks like, why isn't this moving? It looks like headlines telling you institutions are gone because price isn't at a new high. Meanwhile, the actual institutions are filing new products, buying through existing vehicles, and warehousing coins in custody structures that are much less price-sensitive than hot money traders. And remember something else, even the recent inflow rebound has happened while Bitcoin is still well below its October 2025 high. That means this is not purely a momentum-chasing story. The market is seeing renewed institutional interest after a major correction, not only during euphoric highs. That is important because it suggests the buyer base is broader and more process-driven than the old cycle caricature, where institutions only show up after everyone on social media is already screaming moon. If this flow pattern continues, the next thing to watch is not a random influencer target. It is whether the market keeps absorbing supply in the current range while ETF and treasury demand remain positive. Glassnode said sustained absorption across the $60,000 to $72,000 corridor could lay a durable foundation for the next advance. That is the real question now. Not is Bitcoin volatile? Of course it is. The real question is whether this range is serving as a transfer zone from weaker hands to stronger balance sheets. If the answer is yes, then today's frustration may look very different in hindsight, because once overhead supply gets sufficiently worked through, the market no longer needs a tidal wave of new buyers to move. It just needs marginal demand to hit a float that has already been tightened by custody, treasuries, and lower exchange balances. That is when price can move much faster than the narrative does. That is when people suddenly start calling it a breakout, even though the real setup was building quietly for months. And if the answer is no, if ETF flows roll back over, if treasury buying stalls, and if the current demand corridor breaks, then the market probably needs more time. That is the honest version. There is still real overhead risk. There is still macro uncertainty. There is still a market that remains partially hedged and partially defensive. But even that bearish case does not erase the structural shift. It only delays the moment when tightening float becomes obvious to everyone else. This is why we watch these signals every day here on Safe Haven Metals. Not because every green candle means something profound, and not because every red candle means the thesis is broken. We watch the plumbing. We watch who is taking supply off the table. We watch whether the liquid float is shrinking or expanding. And right now, the weight of the evidence says the Bitcoin market is still being quietly tightened by institutional vehicles, even while price is busy arguing with trapped supply from the last leg. So here's the question I want to leave with you. Do you think Bitcoin is building a real base in this range while Wall Street continues to absorb supply? Or do you think the market needs one more flush before that tightening float finally shows up in price? Let me know where you think this goes next. And if you want more signal stacking breakdowns like this, where we connect the flows, the balance sheets, and the macro structure the media keeps separating, make sure you're subscribed.